Hi there, my name is Kezia and I'm here to talk about how corporate governance, working capital, and corporate social responsibility can be influenced in a business. First, let us see what is corporate governance, why we need it, and what constitute is the best practice. Corporate governance is required because of a divorce between ownership and control. Shareholders, the main root for the business, and they have their own objectives. What they like to see the directors to do in their business is to work to ensure that the objectives shareholders have are met. But directors too have their own objectives, and they may vary with the objectives the shareholders have. For an example, if the directors are being paid bonus for the year based on the profits they make, it's no surprise that the directors will work hard to produce higher profits this year. That's not necessarily the same as producing long-term shareholders' wealth. Shareholders might think that they could increase their profits by cutting back on training, staff entertainment, research and development, but it wouldn't necessarily be good for the business. So what corporate governance does is seek to try and ensure that the directors behave in such a way to ensure that the objectives of the shareholders are met. Now, corporate governance is a big picture, including the structure of the board, the role of the directors and the subcommittees on that board, and how the board works basically. The role of governance is carried out by the board of directors. Governance involves the entire board, both executive and non-executive members, coming together to make high-level decisions about the directions of the organization. Governance roles include such as strategic planning, oversight, decision-making, and financial planning. The board is responsible for setting the strategy of the organizations and the strategic plans through which it will be met. The board has a responsibility to deliver sustainable shareholder value in both short and long term, and so must plan effectively for this to be achieved. The board recruits, appoints, and monitors the appointment of new senior executives, reviews their performance, and set their pay and other benefits. The board is responsible for creating, approving, and updating the major policies of the organization. These policies will outline the company's mission, values, vision, and structure. Recruiting, remunerating, and reviewing the performance of the senior executives of the organization is another governance role. The board is reliant on these managers and other employees to carry out their duties and responsibilities to the best of their ability, honestly, ethically, with integrity, and with commitment to the organization. To ensure this is the case, the board is responsible for monitoring the employees and all aspects of the operations of the entity. Once you've got the governance structure right in place, internal controls then follows. So, corporate governance is the method by which organizations are directed and controlled. Now, starting off with the board structure, there are various alternatives around the world for the ways in which corporate governance structures are decided by the senior level of the management. Some jurisdictions have what's known as a multi-tier system, where they'll have a supervisory board, which is known as the senior board, where the non-executive directors sit. So everybody of that board has no executive responsibility within the business operation. And reporting into the supervisory board is the management. And this is where all the executive directors and senior managers sit, like the head of finance, the head of HR, the head of operations, and so on. The other common and easy structure used by most of the companies are unitary board structure. In this, the organization has only one board, And on that board, there are executive directors who are with the operational responsibility, and the non-executive directors, the people who are there to ensure that the business is running smoothly on behalf of the shareholders. And I'm going to focus more on the unitary structure as it's the most practical and real method companies use. Now, corporate governance as a regulatory sort of environment can take one or two forms. We can either have rule-based approach, which means you can have a legislation and it's the legal requirements for the companies to follow. If you don't comply the requirements with that act, the company will have to face legal consequences. The other approach is the principle-based approach, which is little bit more flexible in its application. So the issue of the rule-based approach is it is very difficult to come up with rules that suits every circumstances. So with the principle-based approach, you lay out the best practice principle that can be applied in every circumstances. And the other advantage of the principle approach is all the judgments are being made by the owners of the business. Whereas in the rule-based approach, the judgments are made by the courts. When an unitary board is made, half of the board is made up with non-executive directors. So, like I said before, these people doesn't have any business operational responsibilities. They are like high experienced part-timers where they are being paid a salary. So the reason to have a board 50% of non-executive directors is that any decision cannot be dominated by the people with operational responsibility. So the four roles of the non-executive directors are SSRP, which stands for strategy, scrutiny, risk, and people. So they are there to contribute to the strategy of the business, they are there to scrutinize the executive directors, they are there to ensure that the risk management processes are in place, and to monitor the people they have for each task is suitable and they do the right thing for the betterment of the business. And also, it's a best practice to have subcommittees on the board, such as Audit Committee, Nomination Committee, Remuneration Committee, and the Risk Management Committee. Audit Committee reviews the financial statements and it's the clearing point for internal and external audit. And the reason for that is the Audit Committee is made up of typically 3 non-executive directors, 1 independent non-executive director, and 1 with financial experiences, so they have an understanding of what they are reading. And they are relatively independent, which means an internal audit clear to them, an internal auditor therefore independent. And if external audit clear to them, that helps them to make their role a little bit easier. It is important that the Audit Committee reviews the financials properly, as many companies have collapsed because of fake financials given to the board and the audit. Financial reports forms the backbone for financial planning, analysis, benchmarking, and decision making. Also, the Audit Committee has the full right to select the independent audit firm. Next, the Nomination Committee. The Nomination Committee is there to appoint a new director by evaluating their qualifications and experiences, to make changes of the structure, about recruiting new people, promoting people, and make necessary recommendations for approval. Remuneration Committee is looked at how directors are being paid, like the salary, bonus, and performance-related pay. And they make sure that the amounts are sufficient for the directors for their motivation and encourages them to work for the long-term goals of the shareholders. Nowadays, it's really important to have the 4th committee, the Risk Committee, to take the responsibility of the Audit Committee and give risk management a bit of specific focus. So, now let's have a look how the board should spend their time accordingly. Governance is not management. It involves the exercise of power, formulating strategy, setting policy, supervising management, and being accountable overall. For accountability, they have to spend 13% of their time. The highest amount of time should be given for strategy formulation. For monitoring and supervision, they have to spend 24% of their time. And finally, 14% of their time should be allocated for policy making. So, accountability and monitoring is done to analyze the past and present operational details. And strategy formulation and policy making is done to focus on the future focuses. The main focuses of the corporate governance are leadership, effectiveness, accountability, remuneration, and relationships between the shareholders. So, in leadership, you have to look at the role of the CEO, the chairman, and make sure that the given roles are worked well. Next, you have to see the effectiveness of the directors, like whether the directors have time to do their job, whether they have correct information to take decisions, and so on. Then, the accountability of the board, and clarify accountability of the different members of the board and the subcommittees. And those said people are responsible for the business operation. Then the remuneration is to ensure that the directors are remunerated in an appropriate way to encourage them to think like shareholders and behave how shareholders want them to behave. And finally, to ensure that they maintain a good relationship with the shareholders. Now let's take a look at what working capital is. For any organization or for any startup to really function and flourish properly, they need to have a good amount of working capital for its day-to-day expenses. So let's see how to raise the working capital and also what to do with your working capital. So what exactly means by the word working capital management? Capital which is needed by a firm to meet its day-to-day expenses is known as the working capital management. In short, it's calculated as current assets minus current liabilities. So, under current assets, we have cash in hand and cash at bank, inventory, and accounts receivable. Under current liabilities, we have the short-term loans, accounts, and other payable. Main components of the working capital are the inventory management, debtor management, supply management, and cash management. So, this is the working capital cycle. It's simply how you can convert your cash to raw material, then how you can convert the raw material to finished goods, and finally, how you can convert those finished goods as accounts receivable to your company. Inventory management, which is really how about you're managing the inventory of your company. This could be either a product or a service. Supply management is the way the company manages their suppliers. When it comes to payments, there are different payment methods suppliers offer, such as cash on delivery. If it's importing, you get cash against documents, DA terms, open account terms, and LC terms. It's always better to negotiate a good credit term with the supplier, as it's like a non-interest loan facility we have received. For an example, if you agree to pay our suppliers DA 90 days and you have given the goods to your customers on a 60 days credit term, by the time you have to pay your suppliers, the organization has enough money to pay. Cash management means identifying the cash balance which allows the business to meet its day-to-day expenses but reduces the cash holding cost. Basically, it's how you manage the cash into your account and cash outs from your account. So the finance department has to calculate the cash flow and needs to monitor it, because you don't want to run a company when there's a cash crunch, right? So you need to forecast all these way much beforehand so that you won't get a loss when there is an expense occurred. Let's see what receivable management is. Receivable is anything that comes to your account. I'm sure most of you must have heard of cashback facilities, which many people give out as a brownie point for people to come and buy their products. First, you have to see the credit policy, and this attracts customers. And now you have to be a little more careful here, because if it's too liberal, it can lead to high cost of finance. If you are giving too many liberal things in terms, if you are giving too much of cashback offers or multiple options to your customers, it can lead to a cash crunch. And if it's too strict, it could be uncompetitive and result in loss of business. So the organization has to balance it not to be either too liberal or too strict. Now let's talk about CSR, which is known as Corporate Social Responsibility. So CSR is something which has been started by many organizations few years back. So to give you a definition, CSR is a business approach that contributes to sustainable development by delivering economic, social, and environmental benefits for all stakeholders. CSR is a management concept which has been started so that organizations can look at economic, social, as well as environmental challenges which are being faced by people so that their interactions become better with the stakeholders. What is the importance of being socially responsible? Well, a simple fact that is important to business because it demonstrates to the both consumers and to the media that the company takes an interest in the wider social issues and have no direct impact on the profit margins. Not always you need to work for profits, right? At times you need to do your bit for the society so that you have a feeling of doing social service for people without really expecting anything back in return. So CSR is a beautiful initiative being taken by many corporates, and it's a salute to those corporates for bringing this into the working culture. So let's understand what are the reasons for CSR. Well, employees demand company to be socially responsible. Consumers expect better business practices. It creates competitive immunity. Well, by competitive immunity, what I'm really saying is that sometimes you need to become immune to competition all around you. You don't need to concentrate on what competitors are doing and be in competition with them. Rather, it's always nice to take a back seat once in a while and do your bit without expecting anything in return. Capitalism is evolving, and that's again a reason why CSR is important. Finally, it is a moral imperative. You feel good when you do good for other people, right? So morally, ethically, integrity-wise, you feel wholesome and satisfied. Now let's look at the development goals for CSR. They want to eradicate power, zero hunger, so nobody should go hungry and there should be food for everyone. Good health and well-being. Well, if you are physically fit, you are mentally fit too. So it's important to have a good health in yourself. Then for quality education. So nowadays companies are going out of their way to educate people who cannot really afford to be educated. Then we have gender equality. So a lot of companies making sure that women get as much of equality as men. Next is to have clean water and sanitization. Most of the corporates are taking measures to have a proper hygiene and sanitization systems. Affordable and clean energy. This is something lacks in the villages in our country. People in villages struggle big time for power, electricity and other basic needs. For a decent work and an economic growth. Ninth is for industry, innovation and infrastructure. So wherever it's important and possible, we will be having good industries so that people will also get employment. 10th is reduce inequalities. Then it is to have sustainable cities and communication. 12th is for a responsible consumption and production. Next we have climate actions. So we are trying to do our bit to make sure that there is greenery all around, and many corporates are following the Go Green method nowadays. 14th is life underwater. So even below the water there are many lives we have to conserve and protect. And the same way life on the land too needs to have a good life, and we need to make sure that they are safe. Finally, it is for peace, justice and strong institutions. So people should get a free justice and do things in a peaceful manner. So these are the development goals of the CSR. Now let's see the 4 dimensions of CSR. Starting from economical, everyone needs to be profitable. Then legal responsibility, which everyone should obey the rules and law. Next, ethical responsibility, where people have to be ethical and do what is right and legal. And finally, discretionary responsibility, where corporates contribute to the community and quality of life. Here are the benefits of CSR: winning new business, enhance relationship with stakeholders, attracting and maintaining a happy workforce, media interest and good reputation, access to funding opportunities, enhancing your influence in the industry, differentiating yourself from the competitors, saving money on energy and operating costs, and increasing in customer retention. Company failures do not occur overnight. Even when corporate governance procedures and mechanisms are put in place, they can slide over time due to factors such as failure to review and update the policies, losing touch with shareholders, making poor decisions, and the list goes on. So, in order for an organization to stop from collapsing, these measures should be taken place. Directors must act in good faith in the best interest of the board. If this is not compromised and you are unable to do so, you should no longer be on the board. Ensure any matter or decision with which you do not agree is recorded in the minutes of the board meeting. A follow-up email circulated to the board which explains your reasons for not agreeing will further protect you. Non-executive directors should always maintain a questioning mind. They should ensure they understand the business strategy of the organization and should take decisions accordingly. Audit committees should be capable, independent, and effective. Ensure the internal audit reports regularly to the audit committee. Non-executive directors should ensure that risk management systems, processes, monitoring, and reporting are in place. This helps to ensure that negligence and reckless risk-taking are avoided. Also, it is important to ensure that the components of the working capital are monitored. Lastly, it is important to forecast cash in and cash out of an efficient working capital. You have to be aware of how much cash is coming and how much cash is going out of your organization for a very smooth run. Even in a liquidation, if the value of the assets are 100 million and liabilities are also 100 million, shareholders will not get anything. But if the assets are 150 million and liabilities are 100 million, the balance 50 million can be distributed among shareholders. This is the reason why you should always have a working capital at a ratio of 2 to 1. So we have come to the end of this presentation, and thank you very much for sparing your time with me, and I hope that you must have got a clear understanding how corporate governance, working capital management, and CSR can be influenced in a business.